Hey everyone, I'm Aditya and welcome to my Tallyprime tutorial series. If you have always wanted to learn accounting but found it too boring or too complicated, you are in the right place. We are going to start from absolute zero. First, I will walk you through the basics of accounting in the simplest way possible, with loads of practical example as well. And then we will dive into Tallyprime step by step. By the end of this series, you won't just know the theory, you will be able to apply it in real life. So grab a notebook, relax, and let's make accounting easy and fun. So let's start by knowing what accounting really is. Accounting means recording, classifying, and summarizing financial transactions. In simple words, it's a systematic way of keeping track of all the money and valuable things in a business so you can make the right decisions. Through accounting, a business can check if it's doing well, follow the law, and prepare important reports like balance sheet and income statements. Think of accounting as the way we record and understand every financial move a business makes. Without it, running a business is like driving without a dashboard. You won't know your speed, fuel, or direction. Now let's understand accounting concept with few examples. The first one is recording. What does recording means? It means writing down each transaction as it happens. For example, recording the daily sales of a shop in the sales journal. Why is it important to record the sale transaction? Because so you know exactly how much income you made each day. Second one is classifying. Classifying means grouping similar transactions together. For example, putting all electricity, water, and internet bills under the expenses category. Why? To see your total spending on utilities at a glance. Third one is summarizing. Summarizing means condensing all recorded and classified data into clear reports. For example, summarizing monthly transaction to prepare a profit and loss statement. Why? To find out whether you made a profit or a loss in that particular period. Now the last one is tracking assets. Now what does tracking asset means? Means keeping a record of valuable things your business owns. For example, maintaining an asset register for machinery purchased by a factory. What is the reason behind to maintain the asset register? Because to track the value, usage, and depreciation for accurate planning. Let's understand this concept with an analogy. Think of accounting like organizing your phone gallery. Recording is taking the photo, classifying is putting it into the right album, and summarizing is making a slideshow so you can see the whole story at once. Now, once we have recorded, classified, and summarized our transactions, the next big question is how do we know where to put each transaction? Which account should be debited and which one should be credited? That's where the golden rules of accounting come in. Think of them as the traffic rules of the accounting world. They guide every entry so it's end up in the right place. If you don't follow them, your books can quickly become a mess and the reports you prepare later will be inaccurate. The first one is personal account. It says debit the receiver and credit the giver. Now what does debiting the receiver and crediting the giver means? Let's understand this rule with its meaning and few examples. A personal account represents persons, firms, or organization you deal with in business. When a person or entity receives something from you, the account is debited. When they give something to you, the account is credited. For example, you give goods worth rupees 5,000 to Mr. A on credit. Now, Mr. A is the receiver of the goods, because of which he will get debited. The second example is you take a loan of rupees 20,000 from SBI. SBI is the giver of money, credit SBI's account. Second rule is real account, which says debit what comes in and credit what goes out. A real account deals with tangible and intangible assets, things a business owns. When an asset enters the business, it is debited. When an asset leaves the business, it is credited. For example, purchase of machinery for rupees 50,000. In this case, machinery comes in, because of which it will get debited. Machinery account will get debited. Second example, you sell old furnitures for rupees 3,000. Now, in this case, furniture is moving out of business, because of which furniture account will get credited. The third and the last one is nominal account. It says debit all expenses, losses, and credit all incomes and gains. What does this mean? Now, let's understand. A nominal account records expenses, losses, incomes, and gains of your business. When you spend money or incur a loss, it gets debited. When you earn income or make a gain, it gets credited. For example, you pay rupees 2000 as your electricity bill, which is your expense. So, in this case, electricity will get debited because it is your expense. Second example, you receive rupees 1500 as commission, which is your income. So, here commission account will get credited. Now, understand this whole rule with an analogy. Think of these rules as the GPS for your accounting. They tell you exactly where to place each transaction so you never get lost in your own books. So, with this, we have completed our discussion on the golden rules of accounting. We now know how to identify which account to debit and which to credit, ensuring our records are accurate and consistent. In the next video, we will move one step further and see how these rules are applied practically inside Tallyprime, so you can start recording transactions with full confidence. Thank you for watching this video. If you found it helpful, don't forget to like, share, and subscribe so you don't miss the upcoming lessons. Until then, keep practicing and revising because strong basics will make the advanced topics much easier to master.